You know, there's this ritual we all go through every single year. It's usually in February.
Right.
The finance minister walks out holding that iconic red folder, the Bahikata, and it feels like the entire country just, holds its breath.
It is a spectacle, isn't it?
Yeah.
It really is. The stock market gets the jitters. News anchors start throwing around these big phrases.
It's cool prudence.
GDP targets. And
Yeah.
the average person, well, they're mostly just wondering if their phone bill's about to go up.
Exactly. That's it. We all get caught up in the big announcements, a new train line here, a change in tax slabs there, but I feel like very few of us, myself included sometimes, actually understand the machine that's running underneath it all.
That's a great way to put it. It's a huge, complex machine.
So I want to ask you, and I'm asking everyone listening right now, if I stopped you on the street and asked, what exactly is a fiscal deficit and why is that different from a revenue deficit? Could you honestly tell me? Or here's a better one. Why does it seem like the government overspends every single year? Is that a sign of failure? Or is it actually a strategy? A secret weapon, even?
That is the million-dollar question. Or maybe the trillion-rupee question, really. Because our first instinct, our household instinct, is to say, well, if you spend more than you earn, you're broke.
Right. Simple as that.
But macroeconomics, the economics of a whole country, it just doesn't work like your kitchen table budget.
Yeah.
And the answer to all of that, it lies in understanding what the Constitution calls the annual financial statement.
And that is exactly what we're going to do today. We are not just going to skim the headlines. We're going to open up the hood. We're going to tear apart the engine of the Indian state and figure out how it all works.
We're going to find out where your tax money actually goes.
And decode the logic behind those massive, intimidating numbers.
We're basically checking the economic pulse of the entire nation.
I love that. Okay, so before we dive in and open up the books, just a quick orientation for everyone. This is a special edition deep dive. We are curating this specifically as a full summary for UPSC, and it's focused by the Simplified UPSC by PPP channel.
Which means we aren't just having a casual chat. We are going deep into the syllabus. We're covering the NCERT Class 12 Macroeconomics book, Chapter 5, Government Budget, and the Economy.
So if you're a UPSC aspirant, you're going to want to grab a pen because we're going to be flagging some potential exam traps.
Yeah.
And if you're just a curious citizen who wants to understand how the country runs, well, get comfortable.
Sitting in the right place.
And hey, just a humble request before we really get going. If this level of detail, this kind of deep dive is helpful to you, please take a second and subscribe to the channel. Honestly, it really does help us keep these coming.
It really does. And if you're in a position to and you want to support the mission even more, checking out our Patreon is a massive help to the team.
It is. It lets us keep putting in the hours to create this kind of super useful content for all of you. And on that note, a huge warm shout out to all of our current supporters.
You are the real MVPs. You're the ones making this possible.
Absolutely. And you know the drill. Don't forget to like this video, share your valuable comments below. We actually do read them, and it helps shape what we do next.
You do.
Okay, last thing, our resource alert. We know you need notes to go with this. So we've put together free notes with practice PYQs, that's previous year questions, and they are available right now on our public Telegram channel.
But if you want the real keys to the kingdom, so to speak.
Right. If you want access to all the videos in this series at once, plus all the organized premium notes, and we're talking detailed breakdowns, extra PYQs, and even model mains answers for those tricky descriptive questions.
Which are so helpful for structuring your thoughts.
They're gold dust. You can join our private Telegram library. All you have to do is send a DM on the public channel to join.
Okay, housekeeping done. Let's get to it. What is our mission for today? Today's mission is crystal clear. We are decoding Chapter 5. But we are not just going to be reading out definitions. We're breaking down Article 112 of the Constitution. We're going to really nail down the crucial distinction between revenue and capital.
Which is the heartbeat of the budget, right?
It is the absolute core of it. Then we'll look at the three main heads of the budget. And finally, we're going to make sense of those dreaded deficits. We're going to demystify them for good.
I am ready. Let's start with the container, as we called it in our outline, the big picture. What actually is the government budget? Because in my head, it's really just a giant spreadsheet where the government tries to figure out if it can afford new roads this year.
Well, it is a spreadsheet, but it's a spreadsheet that basically defines the entire economy. And to get it, we have to start with this concept of a mixed economy.
A mixed economy. Okay, so that's us, right? India.
That's us.
Right.
It's a system where the private sector, private companies making cars, selling toothpaste, all driven by the profit motive, coexists with the government. And the government isn't just a passive observer. It plays a very large, very active role.
So the budget is its main tool for doing that, for influencing things.
It's the primary tool. It's the steering wheel, the gas pedal, and the brake, all rolled into one. But here's a fun fact, something that often trips people up in the prelims exams.
Okay.
If you take the Constitution of India and you do a search for the word budget, do you know what you'll find?
I have a feeling you're about to tell me I will find absolutely nothing.
Exactly. You won't find it. Budget is a colloquial term, is what we all call it. It actually comes from an old French word, bougette, which meant a little leather bag.
Huh. I did not know that.
But the Constitution of India, specifically under Article 112, refers to it by its formal name, the Annual Financial Statement.
The annual financial statement. Okay, note taken. That sounds much more official. And this covers what time period exactly?
It covers the financial year. So in India, that runs from the 1st of April to the 31st of March.
And why that specific date range? It seems a bit arbitrary. Why not January to December like a normal calendar?
That's a great question. It's actually a legacy of the British colonial system. There's been a lot of debate over the years about changing it, maybe to align with the monsoon cycle or just the calendar year to make things simpler. But for now, we're still on the April to March cycle.
Right, okay.
But here's the really critical part to understand about that statement. It is a statement of estimated receipts and estimated expenditures.
Estimated, that's a key word. So this is a forecast. It hasn't actually happened yet.
Precisely. It's what economists call an ex ante statement. It's looking forward. This is what we plan to spend. It's not an audit report, which would be ex post looking back at what was actually spent.
Okay, so it's a projection. It's a game plan for the year ahead.
It's a game plan. And here's where we get to the first major concept we really need to lock in. The budget has to do two things at once. It has to look at the right now, keeping the lights on, paying government salaries, buying paper for the printer.
The day-to-day running costs.
Exactly. And it also has to look at the long term. Things like building new bridges, taking out major loans, investing in the country's future.
Okay, so short-term versus long-term, or maybe maintenance versus growth.
Perfect way to think about it.
Yeah.
And to manage these two different perspectives, the Constitution requires that we distinguish between two separate accounts, the revenue account and the capital account.
Right, I remember seeing this in the charts they show on the news. So the revenue account, that's the right now stuff.
Exactly. The revenue budget deals with things that affect the current financial year only. It's all about consumption, recurring costs, things that get used up. The capital account, on the other hand, or the capital budget, that deals with the assets and the liabilities of the government.
Assets and liabilities. So that's the real test. That's the dividing line.
That is the ultimate litmus test. If a transaction either creates an asset for the government like building a new school, or if it creates a liability like taking out a loan that has to be repaid, it has to go into the capital account.
And if it does neither of those things,
then it stays in the revenue account. It's just an operational income or expense.
I like that rule. It's binary. It's a simple question. Does this transaction touch the government's balance sheet of assets and liabilities? Yes.
Yeah.
It's capital. No. It's revenue.
You got it. And we're going to come back to that specific test again and again because it gets a little tricky when you start applying it to things like grants or loans given out by the government.
Okay.
But before we get into the nitty-gritty of where the money comes from and where it goes, I think it's worth asking the big philosophical question, why does the government interfere in the economy at all? You mentioned Adam Smith in our pre-show chat. Didn't he basically say the market, the invisible hand, should just handle everything?
Yeah, that's the classic idea, isn't it? If I make bread to get rich and you buy my bread because you're hungry, we both win. The market solves it. Why do we need the government getting involved and, messing things up?
Because what economists eventually realized over a long time is that the market, for all its brilliance and efficiency, has some serious blind spots. It fails in certain areas. We call this concept market failure.
Right.
And the NCERT text outlines 3 specific functions, or you'd say objectives of the budget, that are designed specifically to correct these market failures.
Okay, let's break them down then. The 3 musketeers of the budget. What's the first one?
The first one is the allocation function. And this is all about tackling what's known as the public goods problem.
Public goods. Okay, this is a term that gets thrown around a lot. You hear people say healthcare is a public good or education is a public good. But in strict economic terms, that's not quite what it means, is it?
No, it has a very precise definition.
Yeah.
And to understand a public good, you first have to understand its opposite, a private good. A private good has 2 key characteristics. It is 1, rivalrous, and 2, excludable.
Rivalrous and excludable. Okay, let's use an example. A bar of chocolate.
The chocolate bar is the perfect example. If I eat that chocolate bar,
Then I can't eat it.
exactly. My consumption of it prevents you from consuming it. The supply has been reduced. That's rivalrous.
And excludable.
If you walk into a shop and you don't pay the shopkeeper the price for the chocolate, he's not going to give it to you. He can exclude you from enjoying it.
Makes sense. Simple enough. So a public good must be the exact opposite of that.
Precisely. A public good is both non-rivalrous and non-excludable. Think about something like national defense.
Okay, national defense. The army protects the country's borders. So they protect me. Does my neighbor getting protected by the army reduce the amount of protection I get?
Not at all. It's completely non-rivalrous. Your safety doesn't diminish his safety one bit. And here's the real kicker. Can the army say, well, Dave over there didn't pay his taxes this year, so we're just going to let the invaders attack his house but not his neighbors?
No, of course not. That's impossible. Once the border is secure, everyone inside that border is secure. It's non-excludable.
Exactly. And because you can't exclude people, you run into this huge problem that economists call the free rider problem.
Ah, the free rider. The person who jumps the turnstile on the metro to get a free ride.
It's the same principle. In economic terms, it means that since people can get the benefit of a public good without having to pay for it directly, like buying a ticket, no private company would ever have an incentive to produce it.
Why would they?
Why would a private company build a public park that anyone could just walk into for free? How would they make a profit? They can't charge you if they can't stop you from using it.
So the market just fails. It doesn't allocate any resources to these essential things because there's no profit motive.
It completely fails. And so the government must step in, has no choice.
Yeah.
It uses the budget to allocate money for these goods, national defense, roads, public administration, and it uses taxes to pay for it, which forces everyone to contribute, so there are no free riders.
That makes perfect sense. Now, I saw a little nuance in the textbook about the difference between public provision and public production. That sounds exactly like the kind of thing that would be a tricky multiple choice question on an exam.
It's a very subtle but very important difference. Public provision simply means the government pays for the good or service. It's financed through the budget.
Okay.
Public production means the government actually makes the thing itself. The government owns the factory, employs the workers, and so on.
So if the government gives a contract to a private company like L&T to build a new highway,
That is public provision. The government is providing the funds, but it's private production because a private company is actually doing the construction work.
but if the government owned its own construction company with its own trucks and cement factories like in the old socialist model.
That would be public production. And what we've seen in most modern economies, including India, is a big shift towards public provision while letting the private sector handle the production side, where it's often more efficient.
Got it. Okay, that's the allocation function. What's the second objective of the budget?
The second is the redistribution function. You can think of this as the fairness engine of the budget.
So this is all about tackling the gap between the rich and the poor, right?
It is. The market, as we said, can be very efficient, but it isn't necessarily fair. It rewards productivity, capital, and asset ownership. It doesn't really care if that leads to some people becoming billionaires while others can't afford to eat.
So the government steps in to rebalance things.
It uses the budget to adjust what's called the personal disposable income of households.
Personal disposable income, that's the money I actually have left in my bank account to spend after the government has taken its cut, right?
That's the exact definition. And the government tweaks this number using two main levers, taxes and transfers.
Okay, so taxes obviously take money away from me.
Yes, and they usually do it progressively. A progressive tax system means that people with higher incomes pay a higher percentage of their income in tax. So that directly lowers the disposable income of the wealthy.
And transfers, what are those?
Transfers are payments that put money back into people's pockets. Think of subsidies on food or cooking gas, pensions for the elderly, scholarships for students.
So these increase the disposable income of the lower income groups.
Exactly. So by combining these two actions, taxing the rich more heavily and providing transfers to the poor, the government tries to achieve a distribution of income that society as a whole deems to be more fair.
It's the Robin Hood function of the government.
In a simplified way, yes. And without it, economists argue that wealth concentration could become so extreme that it would actually destabilize society.
Right. Okay, so we have allocation and redistribution. What's the third and final objective?
The third is the stabilization function, and this one is like the shock absorber for the entire economy.
Because economies don't just grow in a nice, smooth, straight line. They have booms, they have busts, they crash.
Precisely. We have what are called business cycles. Sometimes there's a lack of demand in the economy, people aren't buying enough, factories are sitting idle, and unemployment starts to rise. That's a recession.
And other times it's the opposite problem.
Yes. Sometimes demand is too high. You have too much money chasing too few goods, and that leads to prices spiraling upwards, which is inflation.
So what can the budget do about that? It can't exactly force people to go out and buy cars if they don't want to.
No, but the government itself is a huge economic actor. It can manage what we call aggregate demand. If the economy is crashing and the demand is too low, the government can step on the gas. They can spend more money directly, say, by starting a huge infrastructure project, or they can tax less, which leaves more cash in your pocket, hoping you'll go out and spend it.
Like those stimulus checks we saw during the COVID pandemic?
That is a perfect example of a stabilization measure. And conversely, if the economy is overheating and inflation is spiking, the government can hit the brakes. They can cut their own spending, or they can raise taxes to pull some of that excess money out of the system.
So the budget isn't just a boring accounting document. It's like a control panel for the entire economic machine.
That is the perfect way to visualize it. It's a tool to regulate the speed and stability of the economy.
This is fascinating. Okay, so we know why the government makes a budget. Now let's follow the money. Let's get into Section 3 of our deep dive. Where does all this money come from? The receipts.
Right. And just like we discussed, we have to stick to our two-account system. So we divide all receipts into two big buckets: revenue receipts and capital receipts.
Let's start with revenue receipts. These are the good ones, right? The kind of income you want to have.
From the government's perspective, absolutely. And the definition is the key here. Revenue receipts are non-redeemable.
Non-redeemable. What does that mean?
It means they do not create any future claim or liability against the government. If you pay your income tax, you can't go back to the government 5 years from now and say, hey, can I have that money back, please?
I wish. Here's my tax receipt from 2021. I'd like a full refund.
It just doesn't work that way. Once you pay it, it's gone. It's the government's money.
Yeah.
Crucially, no liability is created for the government and no asset is sold off to get the money. That is the core definition of a revenue receipt.
And this bucket is mostly just tax revenue, I assume?
The vast majority of it is tax revenue. And that itself is split into two types.
Direct and indirect taxes.
Correct. Direct taxes are levied on the income and profits of a specific person or company. Think income tax, corporate tax. The person who has the liability to pay the tax is the same person who bears the final burden. You can't pass it on to someone else.
And indirect tax.
These are taxes levied on goods and services. So GST, customs duties on imported goods, excise duties. In this case, the liability to pay the tax might fall on the shopkeeper or the manufacturer, but they pass the burden on to you, the final consumer, by adding it to the price.
I see. Now, the text also mentions something called paper taxes. That caught my eye. Things like a wealth tax or a gift tax.
Yes, these are taxes that have existed in India historically, but they typically brought in very, very little revenue. So they got the nickname paper taxes. They look good on paper. You know, we're taxing the super wealthy. But the administrative cost of actually collecting them was often higher than the revenue they generated. Most have been abolished now.
Okay, so that's all tax revenue, but there's also a non-tax revenue category within this bucket, right?
Yes. This is all the money the government earns that doesn't come from taxes. A big one here is interest receipts.
Wait, interest receipts. Who is paying interest to the government?
Well, the state governments, for one, or public sector undertakings like the railways. If the central government gives a loan to the state of Maharashtra to build a metro line, the interest that Maharashtra pays back every year is non-tax revenue for the center.
Ah, got it. And dividends, too.
Yes, dividends from all the investments the government holds in PSUs like ONGC, Coal India, or LIC. The government owns a huge chunk of these companies, so when they make a profit, the government gets its share.
And all the little things, I guess. Fees for services, fines.
Exactly.
Yeah.
Your traffic challan, the fee for your passport, all of that is non-tax revenue. Even grants and aid that India might receive from foreign countries. All of these are revenue receipts because they don't create any debt for the government.
Okay, that seems pretty clear. Now let's move on to the other bucket, the heavy money, you called it, capital receipts. This is where it gets a bit more complicated, I think.
This is where you have to pay close attention to the definition. The definition of capital receipt is the mirror image of a revenue receipt. It is any receipt that either creates a liability or reduces a financial asset.
Okay, let's break that down. Creates a liability.
The easiest example is borrowing, loans. If the government borrows money from the public by issuing bonds, or from the RBI or from the World Bank, cash comes in, it's a receipt. But now, the government owes that money back. It has created a liability for the future.
So that makes it a capital receipt.
Yeah.
Okay, and the second part, reducing a financial asset.
For this, think about disinvestment. The government owns shares in a PSU. Let's say it owns 60% of LIC. Those shares are a financial asset on its balance sheet.
Right.
Now, if the government decides to sell 10% of those shares to the public in an IPO, it gets a huge amount of cash. That cash is a receipt. But to get that cash, it had to reduce its asset holding from 60% to 50%.
Ah, so because an asset went down, the money that came in is classified as a capital receipt.
Exactly. And this distinction, this is so important for understanding the actual health of the government's finances.
Why is that?
Because, and here's an expert insight for our UPSC listeners, you must learn to distinguish between two types of capital receipts: debt creating and non-debt creating.
Oh, that's a new layer. Okay, break that down for me.
Well, borrowing is obviously debt creating. It creates a new debt that has to be repaid with interest. But what about disinvestment? Or what if the government recovers a loan it gave to a state government years ago?
Well, in those cases, cash comes in, but you don't have to pay anyone back.
Exactly. So those are non-debt creating capital receipts. You're just converting an asset shares or a loan receivable into cash.
And why does this distinction matter so much?
Because when we get to calculating the big one, the fiscal deficit, we treat these two types of receipts very differently. We essentially treat the non-debt creating ones as legitimate income, but we treat the debt creating ones as the problem we're trying to measure.
Okay, let's put a pin in that. That feels like a classic exam trap. Debt creating versus non-debt creating.
It absolutely is. It's a nuance that many aspirants miss, and it's key to a deep understanding.
All right, so we've got the money coming in. Now for the other side of the ledger. Section 4. Where the money goes. The classification of expenditure. And I'm guessing we're using the same two buckets again, revenue and capital.
We are. The logic is exactly the same.
Okay.
So revenue expenditure is all the spending for the normal functioning of the government. And the test is the same. It does not create any new assets, and it does not reduce any existing liabilities. It's just spending.
Yeah.
Consumption.
The keeping the lights on money.
That's the one.
Yeah.
Salaries for government employees, pensions for retired employees, spending on defense services. But the biggest one, and this is often startling to people when they see the numbers, is interest payments.
Interest payments on all that past debt we just talked about.
Yes. It is frequently the single largest component of revenue expenditure. We are spending a massive chunk of our annual income just paying for the loans taken out by governments years, even decades ago.
Wow, so that's money that is just being consumed. It's not building anything new.
Not at all. It's a committed expenditure. It's like paying the minimum balance on your credit card every month. You're not buying anything new with that money. You're just servicing your old decisions.
That's a somewhat depressing thought. What else is in that category? Subsidies must be a big one.
Huge. Subsidies on food through the PDS system, on fertilizers for farmers, on cooking gas. The source material we have mentions that subsidies were around 2% of our entire GDP back in 2014-15. That is a massive amount of money.
Okay, so if revenue expenditure is all consumption, then capital expenditure must be the investment spending?
Precisely. Capital expenditure, often called CapEx in the news, is the kind of spending that either creates new physical or financial assets, or it reduces financial liabilities. This is the future-building expenditure.
So if the government builds a new highway or a new port,
That's capital expenditure. It's creating a physical asset.
if it buys new machinery for a PSU factory,
Capital expenditure.
what if the central government gives a loan to a state government? That's expenditure for the center, but what kind?
Great question. That is also capital expenditure. Because for the central government, that loan is now a financial asset. It will earn interest in the future and will be repaid.
Right, of course. Because the loan going out creates an asset on their books, while the loan coming in created a liability. The accounting symmetry is actually quite beautiful when you see it.
It is. Now, there's a small historical point in the NCERT text we should probably touch on, the idea of plan versus non-plan expenditure.
Yeah, I've heard that this distinction is outdated now, but because it's in the books, we need to know it.
Exactly. This system was formally scrapped in the 2017-18 budget, but the textbook covers it. Historically, planned expenditure was all the money that was spent on projects outlined in the 5-year plans. So typically new projects, new schemes.
And non-plan was everything else.
Pretty much. General services, defense, and the big ones, interest payments and subsidies.
And the book mentions there was a major critique of this system, right? A kind of a perverse incentive.
Yes, the problem was psychological. For politicians and bureaucrats, planned expenditure was exciting. It meant you got to announce a new scheme, cut a ribbon on a new school, but non-planned expenditure was seen as boring, as wasteful. And that included the money for maintenance of existing assets.
So fixing the roof of an old school wasn't as sexy as building a new one.
Exactly. So what you would see is this strange situation where a shiny new hospital is being built under the planned budget, while down the road, the old hospital is literally falling apart because no one wanted to allocate funds to non-planned maintenance. It led to a huge waste of national assets.
That explains so much about the state of our public infrastructure, so getting rid of that distinction was probably a very good move.
Definitely. It allows for a much more holistic and rational view of government spending.
Okay, let's move on to Section 5. We cannot talk about receipts in modern India without talking about the single biggest tax reform in recent history. It's in box 5.3 of the text, GST.
The goods and services tax. The big mantra that was sold with it was one nation, one tax, one market.
And what made it so different from the system we had before, that system seemed incredibly complicated.
It was a mess. Before GST, you had central excise duty at the factory gate. Then you had state-level VAT. You had entry taxes, octroi, luxury taxes. It was a patchwork. And most importantly, we had what was called the cascading effect.
The cascading effect, tax on tax. Can you explain that with a simple example?
Sure. Imagine you're a shirt maker. First, you buy thread. Let's say the thread costs 100 rupees, and you pay 10 rupee tax on it. So the total cost of your input is 110.
Okay.
Now, you use that thread to make a shirt, and you sell the shirt for 150 rupees. Under the old system, the government would often levy tax on the full selling price of 150.
But wait, you already paid 10 rupees tax on the thread that's inside the shirt.
Exactly. So you end up paying tax on the value of the thread again, and even worse, you're paying tax on the tax you already paid on the thread. This effect would compound or cascade at every single stage of production.
Ouch, that must have made our goods really expensive. And GST fixes this.
Yes, through a mechanism called the input tax credit. It's the heart of GST. Now, when you sell the shirt, you can claim a credit for the 10 rupees tax you already paid on your input, the thread. You only have to pay tax on the value addition that you created.
So it eliminates the tax on tax and brings down the overall cost of production.
That's the idea. And another key phrase to remember for exams is that GST is a destination-based consumption tax.
Okay, what does that mean, destination-based?
This is crucial for how states get their revenue. It means the tax revenue goes to the state where the good or service is finally consumed, not where it was produced.
So if a car is manufactured in a factory in Tamil Nadu, but it's sold to a customer in Uttar Pradesh,
The GST revenue from that sale goes to Uttar Pradesh, the destination state, not to Tamil Nadu. This was a major shift in power towards the consuming states.
and the legal basis for all of this?
The 101st Constitution Amendment Act. It introduced a new article, Article 246A, which gave both the center and the states the power to levy GST.
The 101st Amendment, that's an easy one to remember. 101, like an introductory course to a new tax system.
A good way to think of it. And remember the benefits the textbook lists. It creates a common national market. It's meant to improve tax compliance through the online GST portal, and by reducing human interface, hopefully reduce corruption as well.
Okay, fantastic. So we've got money coming in, money going out. Now for the moment of truth. Section 6, balancing the books. This is where the rubber really meets the road.
This is all about the relationship between total receipts and total expenditure.
And it seems simple on the surface. If your receipts equal your expenditure, you have a balanced budget. If your receipts are more than your expenditure, you have a surplus. But let's be realistic. When was the last time India had a surplus budget?
Not in recent memory. We almost always have a deficit budget, where expenditure is greater than receipts.
And this is where the NCERT text gets very specific and very granular, because there isn't just one number for the deficit. The book lists 3 distinct measures, and mixing them up is a cardinal sin for an economist.
Or, more importantly for our listeners, for a UPSC aspirant, you have to know the difference.
Let's tackle them one by one then. First up, the revenue deficit.
The formula for this one is quite simple. It's just revenue expenditure minus revenue receipts.
Okay, so all the day-to-day running expenses minus all the normal non-borrowed income.
Exactly. And if this number is positive, which in India's case it almost always is, it means that the government's regular income isn't even enough to cover its regular running costs.
Okay, that's a very clear and worrying picture. Now for the big one, the one we always see in the headlines, the fiscal deficit.
Yes, this is the headline number. When the news says the fiscal deficit is projected to be 5.9% of GDP, this is what they're talking about.
So what's the formula for this one?
The formula is total expenditure minus the sum of revenue receipts plus non-debt creating capital receipts.
Whoa, okay, slow down a second. Total expenditure minus revenue receipts, that part makes sense. But why are we also subtracting non-debt creating capital receipts?
Remember our discussion about those. That's the money from things like this investment. The government gets cash, but it doesn't have to pay it back. So for the purpose of this calculation, we treat that as a legitimate form of income that reduces the need to borrow.
Okay, so if I put that in plain English, the fiscal deficit is basically everything the government spends minus everything it earns without having to go into debt.
Bingo, you've got it. Which means, mathematically, the fiscal deficit is exactly equal to one thing, the total borrowing requirement of the government.
That's the aha moment. So the fiscal deficit number is the amount the government needs to borrow in that year. They are one and the same thing.
They are the same thing. That number represents the total borrowing from all sources, from net borrowing at home through things like small saving schemes, from borrowing directly from the RBI, and from borrowing from abroad.
So when exercise question 3 in the textbook says the fiscal deficit gives the borrowing requirement of the government, it's not just a relationship, it's literally the definition.
It is the definition. And this connects directly to one of the PYQs we saw in that source material at 25 CSP1 PDF. There was a question in there about government bonds and the Reserve Bank of India.
Right. If the fiscal deficit is high, it means the government has to issue more and more bonds to borrow that money from the market.
And who buys those bonds? Commercial banks, insurance companies, and sometimes the RBI itself. And if the government borrows too much money from the system, it can lead to a problem called crowding out.
Crowding out? What's that?
It means there's a limited pool of savings in the economy. If the government soaks it all up, there's less money left over for private businesses to borrow to build new factories or expand their operations.
So a high fiscal deficit can actually hurt private investment and slow down the economy.
It can.
What?
Or if the RBI just prints new money to finance the deficit, it can lead to high inflation. There's no free lunch.
Okay, so to recap, revenue deficit is borrowing for groceries. Fiscal deficit is the total new borrowing for the year. What's the third and final measure, the primary deficit?
The primary deficit is a more analytical measure. It's for the real policy wonks. The formula is gross fiscal deficit minus net interest liabilities.
So you take the total borrowing and you subtract the portion of it that's just going to pay interest. Why would you do that?
Because those interest payments are for debts that were taken on in the past. They are, in a sense, the burden left behind by previous governments. If you want to judge whether the current government is being fiscally responsible with its current policies, you need to strip out that legacy cost.
Oh, I see. So it's a measure of the current year's fiscal health without the baggage of history. So if the primary deficit is zero...
If the primary deficit is zero, it means that the government's current tax revenues are enough to cover all its current spending, except for the interest on old loans. It means the entire fiscal deficit, the entire new borrowing for the year, is just to service old debt.
That's a really powerful distinction. So a country could have a very high fiscal deficit simply because its ancestors borrowed a lot of money, but its primary deficit could be very low, which would mean the current administration is actually running a tight ship.
Exactly. It separates the fiscal pressures of the past from the fiscal decisions of the present.
This is brilliant. I honestly feel like I finally understand the financial pages of the newspaper now.
That's the goal.
Okay, so let's zoom out a little bit for Section 7. We've been deep in the weeds of accounting. Let's connect this back to the broader economy. We're talking about a fiscal policy now.
This is where we bring the great John Maynard Keynes back into the picture.
The legend himself.
The whole idea of Keynesian economics, which the NCERT text emphasizes, is that the government can and should use fiscal policy, that is, actively changing its spending, G, and its taxes, T, to stabilize the economy and manage aggregate demand.
And central to this idea is this almost magical concept called the multiplier.
The multiplier effect, yes.
I remember drawing endless graphs for this in college. But put simply, the idea is that if the government spends, say, 100 rupees on building a road, the total impact on the national income will be more than 100 rupees. Is that right?
That's exactly right, because one person's spending becomes another person's income. If the government pays a worker 100 rupees, that worker might take that money and spend 80 rupees on groceries.
Okay.
Now, that 80 rupees is income for the grocery store owner. She might then take that and spend 60 of it on clothes for her kids, and that 60 becomes income for the clothing store owner. The initial 100 rupees circulates through the economy, creating more and more income at each step.
Right. But the text talks specifically about something called the balanced budget multiplier. This one always confused me.
It's a favorite theoretical concept for exams because it's a bit counterintuitive. So let's set up the scenario. Suppose the government decides to increase its spending by 100 rupees, but at the same time, it increases taxes by 100 rupees to pay for it. The budget remains balanced. The question is, what happens to the overall GDP?
Well, my gut reaction says nothing happens. You injected 100, but you immediately pulled 100 back out. The net effect should be 0.
And your gut, like most people's, would be wrong. The astonishing answer is that the multiplier in this case is exactly unity, or 1.
Wait, so if you increase spending and taxes by 100, the GDP still increases by 100. How is that possible? Explain this wizardry.
Okay, let's walk through it. When the government spends 100 rupees, G, that money is injected directly into the economy as demand. The first round effect on GDP is plus 100.
Okay, that part's easy.
Now, when the government raises taxes by 100 rupees, T, that money comes out of people's disposable income. But here's the trick. People do not spend every single rupee they earn. They save a portion of it. Let's say their marginal propensity to consume, or MPC, is 0.8.
Meaning they spend 80 cents of every extra dollar they get and save the other 20 cents.
Right. So if the government takes 100 rupees away from you in taxes, your consumption doesn't drop by the full 100. It only drops by 80 rupees. 100 times 0.8. You pay the other 20 rupees of the tax bill out of what you would have saved anyway.
Oh, I see it now. So the positive injection from government spending is the full 100, but the negative leakage from the tax is only 80.
Exactly. The positive push of G100 is stronger than the negative pull of T, which is only 80 on consumption. So the net effect is positive. And when you run the full math of the multiplier effect, it works out that the final increase in income is exactly equal to the initial increase in spending. So if you tax and spend 100, national income rises by 100.
That is absolutely fascinating. So a balanced budget is not neutral. It can still be expansionary.
Correct. And that is a massive conceptual takeaway for a mains exam answer.
All right, we are in the home stretch now, Section 8. Let's do what we promised and bring in the PYQ linkage. Let's connect all this theory directly to how it appears in the UPSC exam.
Let's do it. Let's look at the source materials we have. We've got the NCERT chapter exercises and those PDF extracts.
Right. I'm looking at exercise question 4. It asks about the relationship between the revenue deficit and the fiscal deficit.
A classic question, and now we know the answer. The revenue deficit is a part of the fiscal deficit. A high revenue deficit is a bad sign because it means a large part of your total borrowing, the fiscal deficit, is being used for consumption, not investment. A good answer would explain that clearly.
What about that cryptic question from the 25 CSP1 PDF, the one about BRSR?
Ah, yes. The Business Responsibility and Sustainability Report. The question was asking if it's now mandatory for the top listed companies.
How on earth does that connect back to the government budget?
It's all about the broader context. The budget doesn't exist in a vacuum. The government uses the budget to push for national goals like environmental, social, and governance, or ESG, goals. You'll see budget allocations for green energy or subsidies for electric vehicles.
Okay.
The BRSR is the other side of that same coin. It's the corporate reporting framework that forces companies to be transparent about their own ESG performance. So the government allocates funds for sustainability in the budget, and it mandates that companies report on their sustainability through the BRSR. They are linked policy objectives.
That's a great connection. And there was another one in that PDF about the Enforcement Directorate, the ED, and the Directorate of Revenue Intelligence.
Yes, the question was about which of these agencies falls under the Department of Revenue and the Finance Ministry.
And the Department of Revenue is the one that's in charge of collecting all the taxes we've been talking about.
Precisely. And the Directorate of Revenue Intelligence, or DRI, is the agency that enforces the Customs Act. Remember, we talked about customs duty as an important indirect tax. Well, the DRI is the agency that makes sure people aren't smuggling gold or other goods into the country to avoid paying that tax. It all ties directly back to protecting the government's revenue receipts.
It's all connected. Even that reference to demonetization in the textbook, it made a point of saying that tax compliance improved after the event.
Yes, the text explicitly links it. It argues that demonetization brought more people and businesses into the formal tax ambit, and that the flood of deposits into banks increased their ability to lend, which could lower interest rates. That's a direct chain of events, from a policy action to tax revenue, and then to the broader financial system.
Incredible. We have covered so much ground, from Article 112 to the 3 objectives of the budget, the whole flow of receipts and expenditure, GST, the 3 crucial deficits, and even the balanced budget multiplier.
We have built the entire machine piece by piece.
So as we wrap this up, let's end with a final provocative thought. We know that deficits are generally painted as bad in the media, fiscal irresponsibility, but you hinted earlier that there's a deeper dilemma here.
I did. Look, a textbook itself presents this dilemma perfectly. On one hand, it states very clearly that a high revenue deficit means the government is dissaving, which implies fiscal imprudence. It's borrowing to consume. But let's play devil's advocate for a moment. The same textbook, in the section on objectives, says the state must pursue social goals, like education and health, because the free market will ignore them.
Okay, so there's a tension there.
A huge tension. What happens if a government becomes completely obsessed with eliminating the deficit at all costs? This is sometimes called fiscal fundamentalism. What if it stops spending on building new schools and hiring doctors just to make the numbers on the spreadsheet balance? Who ultimately suffers?
The people who rely on those public goods, the poorest and most vulnerable sections of society.
Exactly. So here's the final provocative thought for you, for everyone listening, to mull over. Is a budget deficit always a sign of a weak and irresponsible government? Or can it sometimes be a sign of a government that is stepping up to invest in its people when the private sector won't or can't? Finding that balance, the razor's edge between fiscal prudence and social welfare, is the ultimate unanswered question of macroeconomics. And it's a question you need to be thinking about.
That is a powerful place to leave it. It transforms this from a conversation about accounting into a conversation about morality and national priorities.
It is. At its core, that's what the budget is all about.
Wow. What an incredible deep dive. To all our listeners, if your brain is buzzing right now, that is a very good sign. And remember, if you want the written down version of all of this, the premium notes with the detailed formulas, the comparison tables, and those model mains answers for questions like, is a fiscal deficit always a bad thing? You need to join the private Telegram library.
It's the absolute best way to revise and consolidate all this material quickly.
Just DM us on the public channel to join. And please, please subscribe to the channel if you can. Support us on Patreon. It keeps the lights on over here so we don't have to run a revenue deficit of our own.
Lasses. We definitely want to avoid that.
A huge final shout out to our supporters. You are the best. And don't forget to like, share, and leave a comment below. We really want to know your take on that final question. Should the government borrow more to build more? Or should it tighten its belt? Let us know what you think.
See you next time.
See you in the next deep dive. Bye.